Crypto Hotep here with another investing video. We are on week 41, moving right along with the family portfolio and dividends tracker. If you're unfamiliar with this concept, please do yourself a favor. Go to my channel, go to week number 1 under the investment journal playlist and watch/listen to that. Basically, what we did was I crafted a short list of stocks that I asked my family to choose their favorites, those type of things. And I took those choices and we use M1 Finance as our broker of choice to then create individual pies for each family member. And each of those pies creates one big family portfolio. Each week, we look over the family portfolio. We document things like account balance, dividends, the markets, and different events that are going on and how we're feeling. And these videos primarily are to be helpful for my family and myself in documenting that whole investment journey and showcasing that putting your money away just in a bank doesn't cut it anymore, and anybody can invest even with small amounts of money. If you find these videos also helpful, feel free to like, subscribe, comment. But by any means or by no means is this financial advice. Please do your due diligence when looking and investing into stocks or anything for that matter. With that being said, we'll jump in here. So before we go to week 41, we always go backwards. Go to the previous week, week 40, to see where we were at. We were balance-wise, we're at 1623.80 with a money-weighted rate of return of 43.93%. Very good year to date. It's fantastic. Market gain of over $279.27 and dividends earned of $12.37. Okay, this week we did go down, as you can see here. So we just barely cracked the 1600 again. So we went down 1647 cents is the balance. Weighted rate of return went down 36.9%. Still a fantastic return. Market gain went down 239. Dividends obviously remained the same. So what happened? Well, what happened in a nutshell, and we'll go through this after we go through our portfolio, is Fed rate cuts came in play this week. Now, if you've been following this channel and following these updates, I've been speaking about Fed rate cuts since there was a notion or a prediction that rate cuts would be coming in the later half of this year. And basically what happened was when the Feds make the announcement of the rate cuts, there's also a presser or a press conference that goes after these rate cuts that Jerome Powell answers questions from the press. Some of the answers that he gives to the press are either accepted by the market and widely favored, or the market does not like at all and the market will sell off. This week was the latter. So there were several kind of notions that Jerome Powell made in terms of Fed rate cuts and how he sees the Fed rate cuts to be in the near future, i.e. next year, that the markets didn't like. But I feel the opposite way. So we can talk about that. But let's look at what we have here. So on the activity side, between this week and last week, let's look here. We've had a lot of dividend activity. So between this week and last week, we looked at, we were right here. So we had Microsoft, dividend activity O, Realty Income, Cintas, Moody's, Hershey Company, Duke Energy, Google, McDonald's, Coca-Cola, the GOAT right there. There was also a dividend adjustment with Nintendo here. And I obviously didn't make these adjustments. The broker M1 Finance made these adjustments for me and eventually paid out that dividend from Nintendo. Then on the 19th, we made our deposit, $15 there. And again, we've made these $15 consistently throughout this year when we started these videos. So again, we're not breaking the bank here, and that's on purpose because we want to build this small account just from those humble beginnings, just from those small deposits in here. So with that 15, we bought more Celsius. As we know, that's on my wife's portfolio. Starbucks, Old Realty, we bought some more, Target, and then McDonald's right here. Okay. And we also got dividends from Waste Management Group as well. So as always, we go from bottom to top, looking at each other's portfolio. And unfortunately, my wife is at the bottom. But again, this week, we have decreased or lessened that gap of how much my wife is down. So again, this is very encouraging to see. Whereas, yes, we are down in double figures, right? But it's far less than what it once was. At one time, her portfolio was down over 25%. And that's all because of Celsius. Now we're closing that gap. Yes, we're down 18%, but she has some heavy hitters that are pulling up the slack. So before, we really only had Celsius. That was the largest position. We had Google and we had Pepsi. Now that we brought into Tesla and Google, that's kind of leveling out her portfolio, which is helping in the long run. So Google and Tesla both in the green, both double-digit returns. Celsius is still down over 67%, but I believe it has reached a bottom in terms of price from what I see on the charts. Pepsi down over 12% from Pepsi currently. I still like Pepsi. I'm not really worried about Pepsi at all. But overall, we're slowly but surely trying to turn the page here with my wife's portfolio. Okay, let's go to the middle. Our middle's up over 22% year to date. Dividends earned about 49 cents here. And again, just a collection of great companies here. We have Amazon, Target, Starbucks, Costco, Nintendo, and Tesla. Now, Starbucks down over 11%, Target down over 10.5%. These two have been down consistently from the past weeks. Target based on earnings, and then also Starbucks as well. So again, these are, for me, these are solid buys, solid holds as well. I'm interested to see Starbucks plans in the 2025 year. And then Target is very consistent. So I think Target will definitely turn around in her portfolio. All right, our youngest, let's see what our youngest. Again, our youngest kind of killing it right now. Year to date, 60%. That is not a typo. I've been saying that for a while now, but not a typo at all. 60%. Nintendo up over 18% on Nintendo. Tesla up over a staggering 167% on Tesla. Apple up over 50%, and then Starbucks up over 5%. And again, the reason why this Starbucks holdings is different than our middle Starbucks holding is because we obviously bought Starbucks at a lower rate here. So we bought at a lower rate here than our middle stocks, and you see the differentiation in price there. Okay. Let's look at my stocks. In my stocks, we have 16% weighted rate of return. Not bad at all. Market gain of around $63, and then dividends earned $8.36. The biggest Achilles heel for my portfolio, because I have a collection of 50 holdings, so 50 stocks in this portfolio, each categorized here by its own sector. Probably the main one is pharmaceutical. We have Johnson & Johnson in here and Pfizer. For the past couple of weeks now, these have been the Achilles heel, or this sector has been the Achilles heel of the portfolio. But again, I believe these will turn around. Pfizer and Johnson & Johnson are very good companies, very well-known companies, and dividend kings. So I'm really not worried about them in the long run. Okay, technology up over a staggering 30%. year to date here, you can't really go wrong with the collection of tech stocks that we have here. Advanced, we would be up even more if it wasn't for AMD. I think 2025 could be AMD's year here. I think they'll turn around in terms of the stock price. Their business model's great. Everything's solid with AMD. I think they're just on the low end in terms of stock price currently, and it's just basically a correction, and I think this will turn around. But everything else on the technology sector, fantastic. I love in particular that Broadcom, ticker AVGO, and Apple are teaming up to help with building of the AI and syncing that with Apple Siri. So I think that's a huge collaboration, and that benefits both stocks. And when I did see that, I was so happy that I hold both of them. Okay. We speak to the growth in the meme stocks. I touch base on that several weeks now, just because the gains are ridiculous. But if you look, the allocation is only 5% of my total portfolio here. Reason being, just as great as these gains look, these stocks can also dip very, very sharply as well. So I may increase this at some time, but right now I'm pretty set with these allocation targets here. And so I'm not looking really to adjust them currently. Okay. And with that being said, guys, we can kind of stop here. But family portfolio still at 1,600 barely due to the market dip last week. Market gain of $239.36. Money weighted rate of return of over 36.9%, almost 37. And then dividends earned $12.42. We also, before I forget, our oldest is at the top of the ladder, and our oldest is still, even though there's been a dip in these stocks, our oldest portfolio is still the top portfolio in the entire family portfolio. So money weighted rate of return over 92%, was 100% last week. Darn, went down 8%, but still over 92%. Market gain over $122.59, and still able to garner some dividends here, there. So this has been a bulletproof portfolio here. Just very simple and simplistic way of investing. Tesla, Apple, McDonald's, Costco, very known brands, very famous companies here, and very strong companies. And I think this is a good point to mention with investing. Sometimes you don't need this large portfolio, i.e. mine, where we have 50 stocks and holdings, almost like an ETF, right? Sometimes you just need to be focused on a couple great stocks, a couple great companies, fantastic companies with good valuations and good financials. And sometimes you just need to focus on those. And this is what our oldest has done. It's just these 4 straight stocks here. They're great companies. They're not going anywhere. And they've made their name. And most of them, if not all, are the top player in its industry. And what I mean is, with Tesla, with the EVs, there's other companies that make them. But as soon as you say EV or electric vehicle, people say Tesla automatically. Tesla. Cell phones, iPhone, Apple, automatically. I mean, the Android is out there, but I mean, that's kind of that's really here nor there in terms of the Android. Fast food, first name that comes to mind, McDonald's. And then Costco. Costco is probably the best wholesale provider / grocery store / everything market that there is. And there's really no comparing it. Yeah, there's Sam's Club as well, but I mean, Costco has unbeatable financials, and just a continuous process that works decade after decade after decade. So, sometimes you don't need those numerous stocks that you have. And I personally wanted those 50 stocks. I like the companies that I have, and I want to see how big I can get it. But again, we give you, with the family portfolio, we give you both sides of it. We give you, hey, you can have those 50 numerous stocks there, which sometimes for some people that might not even be a lot, because there's some portfolios with over 100 stocks. But then you can be more centralized and have, say, a handful, four to 10 or so. But with that being said, guys, we'll cover one other thing, and that was the Federal Reserve rate cut. So with the rate cut came in as what it was supposed to be, which is a good sign. We just cut by a 0.25 basis points, so 25% or so. So we went from 475, which was our previous rate, to 450. And basically what that means is money is getting cheaper to borrow because we're cutting the rates to borrow that money. However, again, there's also always a flip that your APY in your high yield savings account will more than likely go down again. So there's always two sides to that coin. And as you can see here, at the peak of the Fed rate hikes, we were at 5.5%. And now we've dropped a whole percent to 4.5%. And this is what the hoopla was about this past week. So Jerome Powell, basically, he mentioned that there would be potentially a limit of rate cuts, and they may be scaling back rate cuts for 2025. For me, that may be fine, only because the rate cuts, you don't want to continuously have these rate cuts, because that usually signals that something's wrong. And you also don't want the rate cuts to be too large or larger than what you're expecting. And what I mean is, if we came in at, say, for instance, we went from 475 to 425, so cutting the rate by 0.5%, then the markets would look at that as a catalyst for something bad that will be happening in the economy, because you can't just continuously cut rates at a very speedy rate. It has to be very gradual, just like how you hike the rates up. It has to be very, very gradual, and then so the economy can kind of bottom out and solidify. So that's what the hoopla was about. The markets really didn't like Jerome Powell's takes on certain questions. And again, as always, the markets overreacted. I think the markets upcoming will be more favorable. But with that being said, guys, again, I hope these videos are helpful, and I hope you get what you need out of them. Feel free to like, subscribe, comment. Let me know what you think. And as always, thank you, and happy investing.